maybe we'll start from the beginning.
Yeah, okay.
Did I read correctly that you originally did some work experience as a school teacher? Is that correct?
So it's interesting because my mother wanted me to become a kindergarten teacher, and I enjoyed being with children, and I have 3 kids of my own, so I love children. But I did do that, and I was just brain dead. So I did the week experience and went, no way. And then my father said to me, well, why don't you try stockbroking? And so I went and did a week's stockbroking experience at Nevitt's in Brisbane and loved it. Absolutely loved it, and thought, right, that's it. That's what I want to do. So I did economics at university.
Can you remember, is there anything about that first week in a stockbroking firm what was it that caught you? What gave you the bug?
I think it was because it was fast-moving environment. It was loud. You had to actually read things really quickly, digest the information. You could see that, money was being made. I think the whole thing just gave me an absolute buzz, and I really just loved it from the outset. And then they said to me, oh, you really seem to enjoy this, why don't you go down to Sydney? And I actually got to go on this ASX floor before it was closed, just as a student, like at age 17, and just went, wow, this is amazing. That was the loud cry. I mean, of course that doesn't happen now, but that was another experience in itself.
Yeah. And now you've gone from that experience. You said you studied economics at university.
Yep.
What was your starting point in funds management?
So I started off in banking, right? And then when I came back from London, I was working over there for Credit Suisse in their financial control office for a while, and then came back here, and a friend of mine actually rang me up and said, I've just gone for a job at SBC Australia, right? And I'm in marketing, I'm on a really good salary, I don't want to take the pay cut, but they're looking for someone like you who's had some experience, but pretty cheap to hire. And so I thought, yeah, okay, I'll give it a go. So I came down, had a meeting, and it was with Owen Evans as his assistant analyst, and Russell Abood was the head of equities at the time. Shane Finnemore and Angus Murnahan were on the desk. Andrew Rennie, who's head of Goldman's now, they were all there. And even Mark Steinert, he was in research, now the CEO of Stockland. He was covering property trusts in the research department. So it was amazing.
A bit of a breeding ground.
Oh yeah, it was a real breeding ground. And that was really interesting too, because SBC Australia at the time was huge in fixed interest. So we sort of had that whole trading floor mentality. And again, there was 2 women on the floor in the equities team. I was the second one. And I walked in and went, wow, what have I done here? Because it was so male.
Yeah.
But no, I loved it.
That gender diversity issue is something that you've said is personal for you.
Yep.
10% female representation in the front office of funds management. How do you how do you think change can be made, and what do you think is stopping more women getting involved in funds management?
I think what's stopping, it's sort of on both sides, right? The turnover in the industry, once you're in this industry, most people love it, right? So you almost have to get pushed out for not performing as to why you get pushed out of this industry. So this turnover is very low, right? And I even look back, we tried to hire someone, 4 or 5 years ago, and we put an ad out there on Seek trying to find someone. And I think of the 170 applications, we only had 7 women, right? So I don't think there's a real understanding. I think when people think of funds management, they think of shows like Wolf of Wall Street or Billions. They don't actually understand, what is the day-to-day job and tale of a fund manager. And so what we've been trying to do about it is a group of fund managers and industry funds have come together under the banner of Future Impact, and we're trying to get more women to come into the industry from a graduate level. So we know that 50% of finance graduates are women, so why can't we get more of those graduates to come into the funds management industry? And that's what we're encouraging. And the interesting thing is that even since that started, which was only 2 years ago, we're starting to see the slow change occurring and new women coming in, which is fantastic.
A question for you: that if I was a student considering what options I have, or I've got young kids as well, where do I think about where would I like them to have a career, or what would be a potential career option for them? As we sit here today, there's actually a number of markers that suggest that funds management and active managers are having a really testing time.
Yep.
Do you think that the industry long term if you go and speak to these young women leaving university, that you can put together a compelling case for the health of the active management industry long term?
Oh, that's a really interesting question, James, because this always happens, I think, late in the equity cycle. Active managers always tend to be focused on the valuations, whereas the momentum keeps travelling, right? And if you think about it, the bottom of the market was March 2009. Here we are in 2019, and we've had a few wobbles, but I think that's part of the issue. And I also don't think, if I look back a year ago, right, and work out what we were thinking then versus today, I don't think anyone predicted that the 10-year, Australian bond would be yielding less than 1%. Yeah. No one predicted that, right? So to outperform in the last 12 months, you've had to be, long growth, long REITs, long gold, long bonds, the bond proxies, yeah. So it's just been a very unusual set of events in the last 12 months. So I think, still give the active guys their go. Over the long term, we've outperformed. Yeah. I still think there's a place for us.
I think it's a fair question, though.
Oh, it's definitely a fair question.
And we're at Livewire, we're leveraged to the active manager, and we're, we're a platform where they have a voice. But I just think it's an interesting. It's one of these things. The length of the cycle is something that people, I think, are being surprised. As you say, you turn back. I look at articles that were coming onto the platform 12 months ago. Yeah. How do you feel? It feels late in the cycle. Yeah. 12 months on. Well, still feels really late. Yeah. And I think people have been surprised at how elongated this cycle has been.
Yeah, definitely. And also, obviously we had the fourth quarter was terrible. Yeah. And we all thought, here we go, it's going to begin of the end. But bang, we did the power pivot in January and stock market's up 20%. Mm. So it's very sort of volatile times, and that normally happens towards the end, of a cycle. But the problem is we've got such a supportive interest rates, and we've got central banks that sort of got the stock markets back. Yeah. So if we can just sort out Trump and Xi and the trade war, we'd be right.
In terms of your own experience in how you invest, yeah, has there been someone or a school of thinking that has had a strong influence on how you invest, and how would you articulate that?
Okay, so after leaving SBC, I went into funds management, right? And I've always sort of been on the growthy or the growth at a reasonable price in terms of the way I like to invest. And I started off and made the wrong career choice. I went into a company called Prudential, which eventually got taken out by Colonial. And at the time, they were growth investors. And they moved, within 6 months of me being there, to a value mindset, and like deep value. And it was an edict out of London that this is what they were doing. And I just went, wow, what have I done, right? And it was all on price to book in terms of how they pick stocks, and that was it. And I was just going, oh my God, what have I done? And someone said to me, put your head down, keep working, you're young enough, someone will, pick you and you'll be fine. Anyway, I went to a Wesfarmers dinner. I'm sitting at this Wesfarmers dinner, this guy sits next to me, and I started talking to him. And we started talking about politics, we started talking about corporates, and then we started having heated arguments about stocks and, all of that. And I didn't know who it was, right? But it was Greg Perry. So Greg Perry and Ian Harding, who were the two heads at Colonial First State of Equities.
And Greg Perry is regarded as one of the masters.
Exactly. Yeah. Total master. And it was sort of the late 90s, 1998, and I got a phone call from a headhunter a few weeks later. Said Greg would like to come and have a chat. He's looking for a new analyst.
Can you find that combative young lady that I sat next to at the Wesfarmers dinner?
Exactly. And so that was just a tremendous time. Chris Cuff was running, it was First State then, right? And then we had Pac-Man and Peter Smedley buying all these acquisitions. And then so the business sort of built up in terms of funds under management. Then Commonwealth Bank took us over in 2000. Yeah, so it was just one of those times. And so Greg sort of instilled in all of us about his way of investing and looking for those growth companies at a reasonable price, and looking for those, we called it GDP plus at the time, so looking for those companies that can grow their earnings faster than the economy. Yeah. And so he sort of, between Ian, to give him credit as well, Ian Harding, who was also the Colonial First State, took over from Greg, but he was the 2IC to Greg at the time. He had a big passion for infrastructure. So we were one of the lead fund managers at the time that bankrolled a lot of those Hills Motorway, for example. Mm-hmm. So that long duration investing as well. So look over the horizon. So we learnt those sort of, traits from Greg and Ian.
Does the macro picture, and I don't want to spend a lot of time on things that are out of our control, like
Yes.
whether Donald Trump
Yes.
is going to do a big,
Tweet.
anti-China tweet, or what's happening with the interest rate settings in the central banks in QE. But
Yeah.
even in Australia, there's more rate cuts predicted by the market.
Yeah.
What's your take on this sort of big picture setting? How does it factor into discussions that you have with your team when you're trying to work out how you're navigating from an investor perspective?
Yeah. So we stick to process. But what I would say is one of the interesting things is, and it's happened in Australia as well with these interest rate cuts, is prior to the GFC, when we would have interest rate cuts, usually the stocks that outperformed were the economically sensitive companies. So it was value stocks, it was small cap stocks, it was cyclicals, right? So they're sort of value bent.
Yeah.
That hasn't happened this time, right? In a post-GFC world where it's almost investor mindset of, I don't believe that these interest rate cuts are going to drive the economy higher, so therefore I'm going to go into yield, or I'm going to go into those stocks in a low growth world that are going to deliver me double digit earnings growth rates. So I've been prepared to pay more for those companies. That has been the surprising phenomenon that's happened post GFC versus pre GFC, right? And unfortunately, that's what's happened in Australia in the last few months as well, is that it's been the growth stocks, the tech, the healthcare stocks, and the REITs and yielding stocks that have performed really, really well.
It's like a game of chicken.
Yeah.
How long can you stay invested in those things? But I guess the movements that we're seeing, the volatility that you referred to, suggests that investors are quite flighty around looking for that change or that inflection point where people move out of those growth stocks.
We've seen quite a few examples where stocks have been priced at their growth stocks, and then they've reminded everyone that actually they're cyclicals, right? Whether it be a Costa Group with the agricultural risk that it's had, that was trading well into the 20s in terms of a multiple. It's ridiculous for the risk that, could occur with that business, and then it obviously has occurred, right? But we've seen it again with companies like Reliance as well. That was a very similar situation where people were pricing it like a growth stock, and there is a cyclical element to its business. So we try and spend a lot of time, and there's 7 of us in our team, so that's what we do, is that bottom-up analysis. And we're only trying to find, 35 or 40 stocks in our portfolio, and we're not going to get them all right because no one's perfect. But we do that bottom-up analysis and focus on each individual company and really understand those earnings drivers of those companies.
We're talking about medical style businesses. You talk about the concept of trying to find companies with good DNA.
Yes.
Or genetic markers is the other thing that you refer to them as. What are some practical exampple? Like tell me a little bit about the process.
Yeah, I'll tell you about the process. So, from those GDP plus days at Colonial First State and that whole focus around the growth in the company's earnings, so we do believe, in terms of share prices over time, that it's the company's earnings growth coming through that will drive that share price, right? And we do believe we're very valuation focused, so there are mispricing opportunities that we can take advantage of, and we use our bottom-up modelling to work out the valuations of those companies. And we also really focused on capital allocation in terms of what boards and management team are doing with our capital, right? So they're sort of our overarching principles. And then what we do is we have a quality screen at the front end, which is all qualitative factors. And there's 7 factors that sort of talk about the corporate DNA, the superior corporate DNA. And then there's 8 factors, which are industry sort of Porter analysis.
Yep.
And that decides whether industry is going through a tailwind or a headwind, right? And they're usually great turning points in terms of what's happening with industries. But it makes our analysts, and of which I'm one as well, very focused on what are those 15 markers we've got and what can we mark them off. And of course, the more markers you have out of 15, the higher the quality of the stock it tends to be.
Okay.
Right? So before we even look at any valuation or do the bottom-up modelling, that's what we're doing, is putting all those companies and trying to put it through the funnel to look at those, the quality screen and what those companies spit out. So, do you want some examples?
I was going to say, can we start with some of the on the company side, like the things that you value from a quality perspective?
Yeah. So what we're looking for is companies that, in terms of revenue, on the revenue line, the product or the good or the service that they have, what makes that tick? Are they an innovative company? How are they spending in terms of R&D on those to drive that sales line? Are they spending the right amount of their sales? Is it not too much, not too just right, to drive that longer term growth rate? We look at obviously management and the track record and the board interaction. We also look at, does this company have superior operating margins? You know, vis-a-vis the other players in the industry, are those operating margins, you know, higher than, and why are they higher, right? But then we also look at, we realise that, you know, companies don't operate in a vacuum in terms of industry factors as well. So we're looking at those factors, which I can go into as well.
Yep.
But I just give you some examples on the superior corporate DNA as well.
Yeah. From a company perspective, is there enough choice in the Australian market for companies with superior DNA, or do you have to start making compromise?
You do have to compromise a little bit occasionally, I would say.
Yeah.
But it is a good way of going up and down the quality screen, right? And we generally, you know, the higher the number, the more you generally like it in terms of the quality of the company. But generally those companies that have 6 or less factors, they're more in your sell or never look at bucket. So it's a good way of screening them out. Yeah.
The other thing I'm interested to know is, in terms of market cap spectrum, do you feel like there's a sweet spot for finding a lot of the top 20 companies are really well known, but they've got there because they have had a good track record, they've been good quality. It feels like a lot of the really strong growth is coming from that mid-cap part of the market.
Yeah.
And I'm just going to throw this last little piece in here. I know when I was reading about your experiences during the GFC, you wanted to move out of owning companies that were too small because you called them lobster pots where the liquidity dried up. So I'm interested, given that you've got this view that we're relatively late in the cycle, are you finding a sweet spot for where you want to have the portfolio set in terms of a market cap?
Yeah, well, we don't invest anything under 200 million.
Okay.
So those really tiny, small cap, we think that's like a specialised, you know, investment area. So we don't do that. And we have, you know, what I was saying before about the economically sensitive, you know, small cap stocks, they're just not getting the same boost from the economy as they once were, right? So unless they've got something special about them, then we're not going to look at them. So we probably dialed down our small cap exposure going back about, you know, 2 years ago. But we still look up and down the spectrum. So just because, you know, it's a top 20 stock doesn't mean that we won't look at it. But yes, as you say, outside of the top 20 all the way down to that 150 is really a sweet spot where we look for companies. Particularly because at the end of the day, a lot of the companies that we do own have gone offshore, right? So they're sort of like offshore growth companies and they're a leader in their industry. So that's how they've got that exposure.
So let's get into it. An example, a stock that you have that you believe demonstrates superior corporate DNA. Can you translate it into a real life example for me?
Yeah, sure. So one that it's obviously topical today would be Macquarie Group. That's a company that I've followed for a long period of time. Interestingly, to start with, the fact that the CEO has actually come from within the company, I think tells it all and tells a lot about a company if you can, you know, through many years keep this succession planning going, and you know, from Alan Moss to Nicholas Moore and now Shamara as CEO of a company, I think that tells you there's something unique about the culture. So for us, when we look at that, you know, one of the things we look for too is the employee engagement and the, you know, the client engagement, and we look at the incentive remuneration schemes around that. And clearly, you know, they are paid very well at Macquarie, but they are paid to deliver. And they've got very strong alignment with shareholders, which is what we like as well. Clearly the way they've gone about their business too, I remember Alan Moss many years ago describing it to me as sort of 40 or 50 small businesses that will change over time and hum, but they have the same capital discipline around them. And it's been interesting to watch Macquarie over many years develop that, you know, industry global leader in that infrastructure space, both from a actual corporate side of consulting, as well as an investor in infrastructure and an owner, a co-owner, a manager of funds. You know, that whole mirror business has been an absolute stellar success story for Macquarie. Great.
They've announced, for context of viewers, they've announced a capital raising today.
Yes.
Can you give us a sense on what your initial assessment of it was?
Look, initially I went, oh, is this top of the cycle? Because let's face it, I still remember with Macquarie raising money September 11th. They had a capital raising for $35, and I still remember that going on. And then they did it in 2007. But more recently, they have tapped the market a couple of times for acquisitions, Asanda and aircraft leasing as well. So I'm not surprised that they're doing it again today. And interestingly, they have called out that they've found another $1.6 billion of opportunities this quarter in which to invest or co-invest in the infrastructure space, renewables and technology areas. So the fact that they're actually investing the money and not just saving it for a rainy day, I think is a positive.
Yeah. There are lots of reasons to be bearish out there, and I'd like to move away from that and focus on some positives.
Yep.
What are some of the, we're fresh full of information from reporting season.
Exactly.
You've got to figure out, you've got to make sense of it. What are some of the positives that you're seeing out there at the moment? What are some of the tailwinds and the opportunities?
Yeah, like going through them, like infrastructure is clearly one that continues to get support. And that's primarily, I think, too, because in Australia, population growth is still growing at 1.6%, right? And we've still got congestion in the cities. And so, companies like Transurban, Sydney Airport are still benefiting from this whole urbanisation and, population growth that's occurring. And then leading on to that would be the tourism sector. So continuing like Aussie dollar at 67 cents, that's just clearly positive for offshore tourism, if they can afford it.
And probably domestic tourism as well.
Yeah, get people to stay at home more likely.
Doing a staycation.
Exactly. So that's very positive. You've got to find ways to play it. That's the problem.
It's always been
in the
a bit
listed market.
Education and tourism have always been quite limited opportunities. Right?
Yeah. So, we've been investors in IDP education for a long period of time. We did sell about 3 months ago. So we've sort of ridden that wave and we're out of that stock. But that's obviously been clearly one that's benefited from the 15% per annum growth in that whole education university space. So that's done well. And that's clearly an industry that's experiencing tailwinds as well. And then beyond that, obviously the economy is not performing that well. And then if you go through the sort of the big barbells in terms of resources and financials, that's still doing it tough. And now you've got commodity prices falling away on the resources side as well. So that's going to be harder.
One of the things that's happened on the back of the RBA cutting rates is that it feels like residential housing, after a couple of years of sliding down, feels like it's getting at least a bounce of some description at the moment. It's a big part of the economy. Construction employs a lot of people. Have you got a view on what's happening in that space?
House prices are definitely positive, right? And you've seen that, some glimmer of hope. And the sentiment, the clearance rates, the listings are still negative. But I think when we've spoken to Domain and realestate.com.au management, they've said if we can see the turnover happening at the suburb level, that should encourage more listings. But then on the housing construction, look, the multi-dwelling, I think that's going to be in a downward cycle for a while. Yeah. And I think the problem is that the banks still haven't supported that side of the market. Whilst they're supporting a little bit, but they're still under quite a lot of macro-prudential control on the mortgage side, I still think there's going to be some issues in terms of the property development side. That'll take some time. So more like 2021, not in the next 12 months.
You've got 3 kids?
Yes.
What lessons about investing have you taught them, or will you taught them?
I think some days they're really interested in who I met, today, and then other times they're like, "Oh, Mum, you just look, too tired and too stressed." What would I teach them about investing? Right, I would teach them to be patient. I would teach them to be diversified. I would teach them about the fact that companies' share prices over time grow with the company's earnings. So try and understand what are those 1, 2, 3 earnings drivers, those key earnings drivers behind that profit line and what's driving that profit line. And then I would also teach them, because at the end of the day, we're still very focused on valuation. So I would, the whole fad, and don't get carried away in terms of a stock price just because everything looks like it's going its way and it's going to the moon. Usually that's a signal to sell and move on, let it have a bit of a rest, and then move back in later on if you like it, and the share price retreats. But I think the patience, diversification and the earnings drivers are probably 3 of the keys that I teach them.
Great. Well, listen, I know it's a really busy time, so I appreciate you coming in and speaking with me today. It's been great to hear a background to Wavestone and learn about how you invest, so thank you.
Thank you, James.